You had turned down monthly rent of $5K.
This property, it had a nickname with code inspectors as the Little Shop of Horrors.
This is the Cash Flow Digest. My name is Matt Faircloth, and me and the DeRosa team are here for you guys on a weekly basis with this podcast, YouTube video, and broadcast recording. This is also live on our Facebook group, DeRosa Insiders. We're going to be talking about things that are affecting the real estate industry, news in the real estate investing world. We're also going to be bringing on guests that are crushing it in the cash flow sector of real estate investing. If you guys want to join and watch the show live, please go to Facebook and look up DeRosa Insiders and join that Facebook group where we record this show every Friday at noon Eastern. Hope to see you guys there.
What is up, everyone? This is the Cash Flow Digest. I'm Vinny Celeste. Matt's out this week. He's actually out in Costa Rica. Not as sunny over here in Charlotte, North Carolina, but happy to kind of take it up while Matt's away here. And we've got a really great show planned for us here. Without further ado, let me bring on our guest for the day, and really honored to bring him in here. Matt, welcome. I'm really excited to bring you on. So first, I think introduce yourself, catch us up. What have you been up to these days, and kind of bring us up to speed on your business and your line of work.
First of all, thanks for having me on the show, Vinny. What I've been up to these days, and people ask me this, is risk management. What I mean by that is I'm an active real estate investor and developer, and my background is in multifamily. We've always been opportunistic purchasers. Over the past few years, we haven't been able to purchase any multifamily because the prices really haven't worked for what our return requirements are, risk-adjusted return requirements. So we actually pivoted into office, and people thought we were psycho for doing that. But we were noticing that the investment community was kind of redlining office product because of COVID and throwing the baby out with the bathwater. So we were able to find some great deals that had really, really strong office tenant bases. We just closed a deal that was mostly government tenants on super long-term leases. And those government tenants are very, very sticky. They stay at their properties for decades. And so right now we're sort of seeing pullback even in the office product segment. There's our banks, when we're asking for term sheets on deals that are like, we believe are smoking hot deals, because we're buying properties that are based upon current operating financials and current occupancy in place. So we can buy an office building that's at 60% occupancy with great long-term tenants in place, and we're getting the 40% of vacant space for free. So whatever we lease up and cut deals on is basically all profit. Well, banks have gone from 75 to 80% down to 50 to 60% LTV that they're offering. So that is sort of giving us pause. So we're kind of, all right, we're seeing the Federal Reserve is using monetary policy to suck liquidity and cash out of the system. So we're kind of seeing how that weighs out and just treating the assets we have as best as we can, and kind of still looking at opportunities, but not a lot has come up because the bid-ask spreads have been still pretty wide.
Right. No, thanks for that. I mean, that's a great rundown because you're someone who has had your hands in multiple different pots, and just like many of us are trying to find new ways to produce yield. And I think it's interesting that you found yourself in office space. I'm curious about the office space, though. Do you have any desire for like shared workspace or that unleased area? How creative are you getting? I know that some folks are interested in conversions and that sort of stuff. What's the thought process there?
That's a great question. So generally, when we look at a deal that has vacancy, the greatest amount of vacancy, at least in our market, is in the 6,000 square feet plus office footprints. And what we look for on there is that, if we have, let's say, 4 of those suites in a deal that we're buying, we'll first go to market to try to cut a deal with a larger office user and, rent it out at a really aggressive rate. After a certain amount of time, if we're seeing the market speaking to us and we're not getting any activity whatsoever, is what we look at is, are those office footprints easily demisable down into smaller spaces? Because where we're seeing the greatest amount of demand is in executive offices. Businesses that are between even like 1 to 5 employees that need maybe 2 private offices, a little reception area, and maybe a conference room. So we've done those conversions and have at least leased them up. The downside to that is from a management intensity standpoint, because we are vertically integrated. We have our own management company. And when you add more tenants, there's more management intensity, right? And generally those smaller office footprint users, they're not signing a 5, 7, 10-year lease. They're signing maybe a 2 to 3 year lease max. So that's kind of how we backstop, any sort of unnecessary vacancy loss and vacancy loss on those types of deals. But that's what we're seeing is the greatest amount of demand. But it's certainly not the first thing. I mean, we have some shared office use things. It works from a business standpoint. It works from a dollars and cents standpoint. But when you are managing the deal, then it becomes that much more management intensive. And also, banks don't like to see commercial office spaces that are at on 2 and 3 year leases. They like to see longer duration leases.
One thing I forgot to mention, and Matt's out in Rochester. Is that true? Are your offices in Rochester as well?
Yeah, our entire portfolio is right around the greater Rochester area. If you don't know where Rochester is on the map, it's east of Buffalo and west of Syracuse, probably 3 hours away from Albany, 6 hours away from New York City.
I'm always curious about those leases. How long-term are they? I know that they're longer term, and are they triple net?
It really depends upon the type of user. If you're renting a space to a mom and pop type of CPA or something like that, when you start talking about triple net and expense pass-throughs and all that stuff, you can't require a CPA to get a degree in real estate leasing and finance and stuff like that. So we find more on the small business side of things that they just want to know what how their rent is going to be. All right. So generally we'll have a lease that is called, what's called modified gross. So we'll establish a base year. So let's say if it's at $1,650 a square foot, and there'll be plus utilities. And we'll reconcile operating expenses in the property at the end of the year. So if expenses, real estate taxes, repairs and maintenance, all that good stuff go up from your base year, then we reconcile that at the end of the year and then bill that tenant back and then adjust their base rent going forward. So we can hedge our operating expense increases on those leases. And we'll, naturally increase the base rent, let's say 3% or 2% per year in those leases. And they're typically like between 5 and 7 years is mostly because we don't have huge office tenants that occupy 30,000 square feet. We're talking about office tenants that occupy between 3,000 and 6,000 square feet or even smaller. So those people are just not in the realm of 10, 20-year leases like you see in other markets.
I'm curious how the office lending environment might differ from other types of assets.
Office, when you're looking at deals that are $20 million or less, you're going to be using a community bank or a regional bank. Typically in our market, in a tertiary market, that type of product, you're not going to have, Fannie and Freddie agency debt, non-recourse, and, on a 30-year mortgage and all that stuff. It's just not a thing. So those relationships with those lenders are really important. Bankers you may have not even done a deal with, but you've had that, lunch with them, you keep in touch with them, you see them at industry events. Those people return your call when you call them with a deal. If you are somebody that they don't know from Adam and you just call somebody up that is even a referral, they don't know you. They've never seen your face. They never gotten belly to belly with you. So even that relationship is important. Now, full disclosure, Vinny, we are not, 70% of our portfolio is multifamily, 30% is other asset classes in terms of office and industrial and all that stuff. So this is just an asset class that we pivoted into when we saw an opportunity. And I had background in managing it because I'd done turnaround and value add deals on office before, and I had a proven track record. I knew what to do with those deals in the process.
I have a note from our mutual friend Spencer here that you had turned down monthly rent of $5,000. That sounds pretty good to me where I'm sitting. Could you walk us through what is the story there?
Yeah, so he's probably talking about my Monroe Megs deal. It was a mixed use apartment building. It was 24 residential units and 2 commercial storefronts. You have to understand the context of this. This property was 2 blocks away from my house. Okay, so there's one major thing that's important there. The unit mix was. There was a Rent-A-Center there. Okay. If people don't want to know what Rent-A-Center is, it's probably a good thing, but they're a very, in my opinion, predatory company that preys on low income people. And rents them crappy furniture and at really, really high interest rates. And then the furniture falls apart and then they end up, repossessing them and suing those people, so it's just and they were there, they occupied 4,000 square feet of storefront retail space. They're paying $2,000 a month. And then there was a nail salon next door, and this nail salon was probably a little bit of human trafficking going on in there. So my whole business plan was I was going to boot both of those tenants out and reprogram the retail in this mixed use deal. Mixed use properties are really interesting, especially if you are buying them sort of on the fringes of a neighborhood. Like I live in a good neighborhood. This one's in an okay neighborhood. And this property, it had a nickname with code inspectors as the little shop of horrors. There was, when I did my due diligence walkthrough, there was people passed out in the hallway with needles sticking out of their arms. Like, this is a pretty bad deal. So my whole business plan was, you can really change the complexion of a property by reprogramming its retail mix to essential services that are going to bring vitality, street level vitality to a neighborhood. So anyways, that was the long story. So Rent-A-Center had about 3 years left in the lease when I originally bought this deal, but they had a 5-year renewal option. And that renewal option was not defined in terms of price per square foot. That was to be negotiated with the landlord and the tenant at that time. So anyways, they were paying $2,000 a month. They reached out to me, hey, can you give us a proposal for an a new 5-year lease? So I just told them, I was like, all right, well, it's and I was legally bound to do this, right, as per the lease. So I was like, all right, well, if you want to stay, it's $20,000 a month. They were paying $2,000 a month. It was my sort of like FU kind of thing there. So then they came back and they're like, okay, well, we can't do that, but we can do $4,000 a month. I was like, okay, well, maybe I'll do $15,000 a month. I'll come down to $5,000 a month. So there's a negotiation thing there. And then they got up to about close to $8,000 a month in terms of where their tops was, right? And I countered them back at $12,000 a month, and they said, we can't afford that. We're going to move. So that's where I turned down a $5,000 a month rent increase on that property. The key is that because this was more of like a repositioning project that I was going to, now like we have a crumpet shop on the first floor where the nail salon was, which is an amazing community asset. They like do these like British pastry things there. I bring my daughter there all the time. She's 3 years old. She loves it. And we have a vintage clothing shop where they do a lot of community events where they do bicycle socials and stuff like that. With mixed use deals, you can't look at the retail, especially in a tertiary market. You can't look at the retail as driving the whole value for the building. What you do is you program the retail to add value to the residential. Right. That's where you make your money and help turning a neighborhood into some place that looks nice, and the the shopkeepers or business owners take care of it. So yeah, I did this deal. I didn't have any partners on it. I raised the money from private money lenders. It was a debt deal, and I brought a bank in on it. If I had a partner on that deal, he probably either would have killed me or sued me for turning down that deal. That's $60,000 a year and almost $1 million in valuation that deal would have added to it. But it wasn't about, I was like, hey, this is already a win. Like, I don't need to knock this thing out of the park. It's 2 blocks away from my house. So that's the reason why I did that deal.
I love that. It really highlights the ability that real estate can have to transform a community. And I'm curious to hear about the appreciation of the asset now with all these ethically acceptable really tenants in place.
Yeah. So we originally bought the deal for $750,000. We put about $350,000 to $400,000 into it in renovations and repositioning the property. The most important thing too is to renovate to where the community needs are. So we did a lot of value engineering. I was like, we have to have these apartments be around $800 a month in rent. Okay. For there to be that sort of sweet spot for affordability with that neighborhood. Affordability in terms of where people that are gainfully employed make well over 3 times monthly rent that are going to go in there and help start, like reactivating this building. After we're said and done, the property reappraised for $1.6 million. So we were able to refinance the property, take our private money lenders out. Now we have it. It's a great cash flowing asset. That deal alone is going to pay for both my kids' college educations or private school if they decide to go to private school, and all of our vacations and trips that we take throughout the year. I didn't need any more out of that deal.
It's such a win-win, right? Because we talk a lot about DeRosa Group's, our trademark is transforming lives through real estate. We really believe in transforming community and making it a better place, safer place, and all the impacts that can have on the families. In your case, one of those families just 2 blocks away. And there's, such an ethical reason to just do good out there and do well, right? But also there's usually a financial benefit when you implement those practices as well. And it just, it can be, real estate really can be a win-win when it's done the right way. So just love that story.
You got to think long-term too. So I think that if you think of long-term value for all stakeholders, you as the investor will make more money, period, full stop. And this is a challenge with, the capital markets and real estate finance, is that we can be a long-term operator with a long-term 20, 30-year vision. But the problem is that our capital markets, our capital partners think 5 years is a long-term.
Right.
So that's where the tail can wag the dog in forcing us there. So, sometimes, we raise money for, equity partners on some of our larger deals, multifamily and office and that sort of thing. But for deals like this, like I'm putting them together where I'm owning all the equity so that I can actually be the one that thinks really long-term. So I don't have that 5-year tail wagging the dog.
That's a really great point. Earlier in our conversation, we're talking about how the benefits of going bigger as soon as you're ready, really, as you gain experience and expertise, going bigger will behoove you, financially. But it's important to say that folks, one way to get bigger is through partnership, and a lot of times people can partner their way out of equity in a deal that they've worked very, very hard to put together. I have a question about that. How do you look at because bringing in partners, you can leverage their expertise, right? And a good strategic partner also could lessen your the oversight required on your end. What kind of calculus are you doing to decide, is this something I can take on by myself, or should I bring in a partner? Do you pretty much try to take down everything yourself? How do you approach that thought?
I mean, I've been doing this for 17 years. When you get enough experience, and you'll probably hear this out there, is like, I have no calculus. I go a lot by feeling. I mean, for instance, the government office building that we purchased, we originally put that out to our investors at I think it was a 9% preferred rate of return. And this is completely private placement. We don't have to worry about the numbers here. 9% preferred return, 5-year term, and a 19% ownership interest in this building, right? We got a full subscription from one of our investors. We got another offer from another investor who was an experienced developer that brought a lot of experience to the table that wanted 10% preferred rate of return and 30% equity on this joint venture. And we went with that deal because he brought way more experience to the table than we did on other stuff that we want to do in the future. If you're looking at my background here, this is one of our buildings. This is an abandoned, this is a virtual background. This is not my studio, but this building is an old historic gum factory. And this developer that we partnered with on this government office deal, has done tons of deals just like this. So right. They can bring a lot of advisory value to you to help you grow. And also they can bring their balance sheet too, which was also important with this. Right. And their balance sheet on that deal actually gave us halo effect on 2 other deals that we were refinancing with the same bank that he wasn't even a partner with. That we got much better rates and terms on other deals that he had nothing to do with, because we brought him in on that one deal and had that track record with that lender. That's
a really good point, because if your strategic partner is an expert in an area where you want to go, there might be more reason to make a partnership, even if you're not financially required to. Mm-hmm. And I think that's some pretty good advice there. I was going to ask you about the background. So what is the plan with that gum factory now?
And so this is a property that is right next door to another property that we own, which is a historic car factory. And we purchased that. We redeveloped it into mixed use, some fitness use, artist studios. There's a vintage clothing shop and like a very, very kind of hipster barbershop that's in there. It was a building that was vacant for 40 years. This building came up in the market, and we purchased it for strategic reasons because it shares a huge parking lot between both of the buildings. With these buildings, you have a vision, you have an idea of what it might be, but you don't know until you find the right tenant partner. We're in pre-development on this property right now. When we have slack in our manpower, we'll send them over to do special projects in terms of fixing windows and that sort of thing. But we don't know yet. We want to reactivate it. I think that worst comes to worst, maybe 3 years from now, if we don't have somebody to take it, because this is a 16,000 square foot building. It would make a great brewery or distillery or urban winery or whatever. Then we'll probably either turn it into residential and do a historic tax credit project on this. Because at that point in time, this neighborhood, there's about $80 million worth of developments happening right next door. So at that point in time, I think that we'll be able to have the calculus to do a residential, luxury loft apartments.
Amazing. Yeah, it's interesting to hear that, how many exit strategies you have. I'm sure that definitely inspired you, kind of made you confident going towards this. Curious though, when you're looking at stuff like this, how do you project out the financial performance kind of without that vision, fully fleshed out?
Yeah. So on this building, for instance, we ran 3 different scenarios. The number one most important thing is that these types of projects take years to do. So first thing you want to understand is, what is my cash burn? Okay. Because you're going to burn through cash in terms of just holding onto the property paying a mortgage payment on it, because we got a private mortgage on the property. It's a 20-year private mortgage. And so, and then we'll run the 3 scenarios in terms of, okay, well, we rent it to one user that's going to take the entire building. We'll look at rent comps in terms of price per square foot and do our projections based upon that. The second scenario is demising all these spaces down right here. If you're seeing this in podcast land, is dividing them into artist studios. There's actually a very strong demand for artist studios in the Rochester area. Rochester has a really, really strong creative community. And then the third is the worst case scenario is residential, which happens to make the most money, but involves the most risk. So that's kind of like where we do that and figure out in terms of CapEx and financial performance after stabilization in terms of those 3 scenarios.
Does multifamily involve the most risk because that's the highest cost to reposition the asset? I'm curious why it's the most risk.
It's the redevelopment cost. So, right. This would be, if we converted this building to residential, it wouldn't even be a repositioning. It would be a total redevelopment. Right. It would be a historic adaptive reuse. So now you have construction risk in terms of cost overruns. You have also lease up risk because your pro forma is in a new market. Like there isn't, a ton of luxury loft apartments that are right next door that we can draw rent comps on and say, if we provide a new product, maybe we can get 5% above where, these ones that are currently trading that were renovated 15 years ago. We don't have that. So we have a substantial amount of lease up risk as well. So when you calculate the risk adjusted returns, that's where, multifamily, redevelopment on this deal is the least desirable in our opinion. So, right. But that's sort of our worst case scenario.
It's not totally round peg, square hole, but it's oval peg, circle hole or something like that.
Yeah.
Well, Matt, I know you're busy. I really want to thank you for your time, but first, folks, I hope you got a lot out of this. Matt's super knowledgeable, has his hands in lots of different stuff, and has been at it for a little while. Please tell folks how they can reach out to you. How can they look into what you're up to and get a hold of you?
Absolutely. I'm on all, I'm pretty omnipresent on social media. So I'm on LinkedIn, Facebook, and Instagram. I also have a weekly podcast called the Go Big Live Real Estate Investors Podcast. And that show target audience is investors that maybe have a few deals under the belt that are wondering how to go big. So I actually have Matt Faircloth on my show next week, and we're going to talk about his first deal.
Funny. Okay.
Yeah. His first deal, how he found it, how he raised the capital for it, how he, brought it full circle, and the lessons he learned in that. So we really got to go very, very much down to the tactical type of stuff there on one particular deal. So, you can find me at any of those places. I'm happy to connect. I'm happy to talk to anybody I'm evangelical about real estate in case you haven't, noticed. So I'm willing to talk to anybody and probably talk their ear off about it. So.
Yeah, no, I'm the same way. Happy to. Right. So thanks again for your time. I'd love to hear the show. I think that's so important for folks to hear about the first one, because it could be so overwhelming when you hear about all the success at one time in 40 minutes of a podcast, right? And trying to put yourself in those shoes, it's hard to imagine sometimes. So thanks again for your time. It's been great. I'm going to let you out and kind of close the show up here.
Hey, take care. Thank you for having me on.
Was that he's able to pivot. He's able to pivot because of his expertise that he's built and the relationships he's built and a history of success. So I hope you guys can take that. I hope you have a great weekend, and I hope to see you next week as well.
Hey guys, Matt Faircloth here. Thank you for listening again to the Cash Flow Digest. I really appreciate you guys doing that. If you guys want to hear more about what DeRosa Group has to offer, go to DeRosa Group, DeRosa Group.com, DeRosaGroup.com online. You can hear about all the great things that we offer from an educational standpoint and passive investment standpoint on our website. See you there. And if you guys want to join our online community, DeRosa Insiders on Facebook, where you can watch this program get recorded every Friday at noon Eastern, and you can come on as even a guest or ask questions on the show. We hope to see you guys on our online community, DeRosa Insiders. See you there.